the best of Money Matters.
Market View on Money FM 89.3.
That's right. You're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Singapore shares dipped today as optimism surrounding cooling global trade tensions fizzled off. The Straits Times Index was down 0.18% at 3,884 points at about 12:17 p.m. Singapore time, with a value turnover of 500 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI eked out gains at the end of the trading day, up 0.15% at the close at 3,897 points. In terms of value turnover, we are looking at 1.14 billion Sing dollars. Gainers outnumbered losers 307 versus 203. Top advances for today we've got for you ASUS, VentureCore and SGX, and top decliners we've got for you GMXUSD, DBS and Global Testing. Now, in terms of counters to watch, we have our national carrier, Singapore Airlines, because SIA posted a 65% rise in net profit to 2 billion Sing dollars for the second half of FY 2025 ended March. Now, this lifted the group's full-year net profit to get this a record 2.8 billion Sing dollars. Now, elsewhere from Singapore's key exports jumping 12.4% on the year to Walmart's CEO warning of price increases caused by US President Donald Trump's tariffs on imports, we've got more economic and corporate headlines in focus. And also on deck, a breakdown of Chinese big tech earnings out this week. So, joining us on the line today is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome.
Hi, Diane. How are you? How was your pilgrimage to Omaha?
It was very fun. It was very fun. I wish it could be a little bit longer. But Ben, we will talk about SIA, the carrier, if you want to take the flight there. But let's start with the Singapore stock market this time around. Ben, how did the STI fare today? Any surprises when it comes down to the biggest movers? I'll name some companies. You decide which one you want to talk about, okay? We have Singtel, which was mentioned in the news earlier. We have OSEA International, up some 41% earlier in the day. We've got Netlink NBN Trust, which recently released earnings for second half ended March. Which stood out to you?
Well, the overall market today was a little bit muted, a little bit flattish. This was in a stark contrast to what happened in the overnight U.S. market, which was up about 0.4%. So I suppose the market sentiment has been improving, and people are taking a little bit more profit off the table before entering into the weekend. So nothing much to read into the tea leaves over there. For the two companies, we can have a quick chat about both, actually. So OSEA International up really is because of the unconditional cash buyout of 16 cents per share by its controlling shareholders. So this is basically a very classic arbitrage trading strategy. So obviously, anybody who was paying attention, quickly jumped onto the news and then bought the share right up to 16 cents because, as owners of the share, they can actually sell it back. Because of the buyout at 16 cents. So it was a quick profit for people with, who have quick fingers, basically, to hit the button. For Netlink NBN Trust, I beg your pardon, revenue was down about 1%, really due to lower ancillary project and connections revenue. I think this could be a cyclical thing. I took a look at the company's presentation deck to investors. I think, what really piqued my interest was that its weighted average debt maturity fell from 2.4 years in December 2024 to 1.3 years in March 2025. So that's actually just a span of 3 months. So that's a little bit curious. And the net debt to EBITDA is up from 2 times to 2.4 times in the same period. So I think, I don't really cover this company, but I'll be, pretty interested to find out why that is the case. And I'll probably ask, at the management at the AGM. But as a business, I think this is a very stable business. So not particularly concerned, but just a little bit curious at the financials.
Now, since it was mentioned in the news, I do want to talk a bit more about Singtel briefly before we move on to SIA, because Singtel sold around 1.2% of its direct stake in regional associate Bharti Airtel for 2 billion Sing dollars. And today we are seeing shares of Singtel. Let me just pick up the numbers over here. Shares of Singtel up 1.33% at the close. Any quick thoughts, Ben?
Well, I think the Singtel had a very good regional strategy for many, many years. So what they're doing now is basically to cash in on investment gains. So nothing particularly nefarious or odd about that. But I think what would be more important would be to strip out the one-off investment gains and look at the underlying business.
Okay.
So that's more interesting. So the share price up today, probably a knee-jerk reaction, but we need to crunch the numbers.
Okay, and Ben, let's talk about Singapore Airlines. It reported 65% rise in net profit to 2 billion Sing dollars for the second half of FY 2025, ended March. And that's boosted by non-cash accounting gain from the Air India Vistara merger. How would you read into the results? And of course, the other thing that stood out to me this time around, the staff bonus for SIA workers, 7.45 months this time around.
Yeah, I'm celebrating over there.
7.45 months.
Yeah. Okay, so if you look at the numbers, right, the full year net income is up 3.9% year on year, mainly because of a one-off non-cash accounting gain from the merger that the Air India Vistara merger that you mentioned just now. But again, if we want to look at the ongoing business, the business as usual items, we need to strip out the one-offs. And if we do that, then the adjusted full year net income is actually down 37%. Very specifically, the fourth quarter FY25 net profit is down 29% year on year. One of the key profitability metrics for the airline industry is passenger yield. So looking at that, that fell 5.5% to 10.3 cents per km. The decline is unfortunate, but the good news is that the decline is actually smaller than the previous 3 years, so that's the silver lining there. I think what was a little bit more interesting was that the management outlook, is kind of clouded by the uncertainties of the trade war and the tariff war and the trade tensions. So with that all in the mix, I think the current stock price as it's trading today is more or less fairly priced. And for the price of the stock to move higher, we are probably going to need a positive catalyst, some good news or something about restructuring, so on and so forth. Well, of course, the elephant in the room is the 7.45 months of bonus. Well, I wish I had that. And I think I would defer that to the Singaporean netizens to argue that out.
I suppose we all wish we had that. The other one, when was it? The shipping company, when it comes out, the bonus number, that sparks a lot of discussion as well. But speaking of shipping, I don't want to move on to look at catering and ground handling, and that company to watch for today is SIAS, because SIAS announced yesterday that it will invest over 250 million Sing dollars to upgrade its ground operations and cargo handling infrastructure at Changi Airport. Now, this will support growing cargo volumes at Changi Airport through to the mid-2030s, when we've got the new Terminal 5 and Changi East Industrial Zone set to begin operations. So what do you make of the move, and how significant is this for SIAS if we look at the price movements today? Well,
if we dive into the 250 million upgrade CAPEX, 150 million is for the renewal and expansion of SG Hub's ground support equipment fleet. The rest going to improve cargo operations. So presumably, I think that would be the hardware upgrades, so on and so forth. So SIAS, with this development, it really positions SIAS to continue to be the go-to provider for ground operations and catering services. And really, they need SIAS to kind of lay the groundwork for T5. So too early to crunch the numbers, but my gut feel is that the development is probably a positive catalyst for the stock, especially if the current trade war ends in a whimper. And really, that's a kind of a higher likelihood of that happening compared to, last week or 10 days ago, simply because the U.S. and China are at least sitting down and having a discussion. And the 90-day pause is still ongoing. So it sounds like if both sides get a win, then that may happen. That will obviously be a uplift for Singapore's economy, air travel, and of course, that's always good for SIAS.
And let's stay in Singapore, Ben. Singapore's key exports Nodex jumped 12.4% on the year in April, outstripping estimates. I believe the median median estimate by private sector economists and a Bloomberg poll was 4.3% growth. So how far are the numbers in line with your expectations? And perhaps the second part of the question is, what does it say about the resilience of Singapore's economy and the outlook of SGX export-oriented counters?
Well, I'm afraid the data is a little bit dirty in a sense that, the jump is mainly driven by, I think, front-loading by Singapore's trading partners to get ahead of the U.S. Reciprocal tariffs. So in economics or in business or in accounting, really, we call it demand shifting, right? So you are moving the volume from second quarter and pushing it to the first quarter, basically just to beat the deadline. Which means that we can't really read much from the tea leaves. So what we need to do, from a data standpoint, is to look at the first two numbers alongside the second and third two numbers to even out the change in the, demand shifting. So then we'll know whether or not that's actually, a good gauge of where the Singapore economy is going. Now, that said, if the tariffs are eventually negotiated down after the 90-day U.S.-China pause, the exports in the subsequent quarters may still show a decline simply because, demand and the orders have already been fulfilled and they've all been pushed in the first quarter. So I think more of a concern, at least from a structural perspective, is the AI, or rather the U.S. AI diffusion rule. So that was the Biden era rule that was supposed to come into force yesterday, but the Trump administration rescinded it. So what they are saying is that they're going to replace it with, as usual, something better and bigger. And that may not be good news for Singapore, right? Because, there are a lot of tech companies in Singapore, Apple, Google, so on and so forth. There are data centers, and of course, Singapore is a hub for the growing data center, business in Johor as well. So we're going to see how that goes. I'm a little bit more curious about that compared to the NODX numbers for first quarter.
Okay, now if you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Across the region, Ben, Hong Kong fell today with e-commerce titan Alibaba down some 4% after reporting a disappointing rise in Q1 revenue because Chinese consumer spending remained sluggish. Now, other tech firms, if we look at JD.com, that was down along with Tencent. Now, Tencent, though, reported a strong set of results earlier. So how would you read into the movements and the earnings by Chinese big techs?
Well, it's a little bit like the tale of two cities, right? So Alibaba is essentially following Amazon's playbook. So they've got the online commerce platform as well as the cloud computing. So what's been happening is that if you look at the online commerce platform, growth in the international e-commerce business has slowed really because of the U.S.-China tariff tiff. But they actually had a stronger than expected fourth quarter China domestic e-commerce revenue. So a little bit of a mixed bag there. But if you look at Alibaba's cloud computing, the growth driver, the cloud computing's margin actually declined and it failed to beat estimates. Now, to be fair, as well, similar to what analysts have been doing to Amazon and Nvidia's numbers, they've been kind of hyping up the estimates, the forecast. So any kind of slip up by the company, will, of course, will be punished mercilessly by the market. So that's essentially what's happened to Alibaba. I don't think this is a structural problem. I think they have got some kinks. They need to work it out, but I don't think this is any kind of red flag for Alibaba. Now, if you talk about Tencent, that's a slightly different thing because Tencent have got two big revenue drivers. That's basically is gaming and is online ads. Now, combined, the revenue for these two segments actually grew by more than 20%. So that's very, very strong growth.
Okay.
So what we can see is that you've got resilience in these segments underpinning, at least near-term growth. And of course, for medium to long-term growth, that's really, we think that is going to be driven by consumer AI monetization within its WeChat ecosystem. So, in WeChat, already in Singapore, we use WeChat as the equivalent of WhatsApp. But actually in China, WeChat is like the one app to rule them all, right? So you can use it to send money, you can use it to chat, you can do
train
everything.
Tickets.
The train tickets, And of course, Tencent is very smart, so they're building AI into it so that, it's going to further the popularity of their WeChat app and to build closed ecosystems, so on and so forth. And I think what we really like, as analysts, right, is the high quality growth. So we really understand what's happening in the business. We like the numbers. and also the fantastic visibility provided by the company in terms of the outlook. So the company was pretty upfront and candid about the kind of risk factors they're facing and also what they're doing about it. Now I think the only negative point here is that the operating profit was impacted by a one-off share-based compensation expense in a overseas subsidiary restructuring. But again, it's a one-off, so it's not going to happen every quarter. So yes, they took a hit, but nothing to do with their underlying business. So that's all good.
I see. Now, Ben, I've got about 2 minutes to go, but I do want to go through the next two questions because they're quite interesting as well. Staying on the topic of big techs, ByteDance is targeting revenue growth of about 20% in 2025 despite a potential economic downturn, which is a pace of expansion that could help it match Meta Platforms' global business. That's, of course, according to sources familiar with the matter. What do you make of that, given the challenges ByteDance is facing with regards to its U.S. business?
Well, to most countries outside China, ByteDance is synonymous with TikTok, right? So the millions, hundreds of millions of users, so on and so forth. And TikTok is the one, the part of business that's been targeted by the U.S. But apart from TikTok, ByteDance also has got chat apps in AI bots, news, video sharing, video editing, so on and so forth. That's the not so visible part because it's really popular in China, but not so popular elsewhere. So yeah, it's not surprised that they're able to grow the business. Also considering that you've got a lot of flip-flops from the Trump administration, so they wanted to ban it. Biden said, yes, you'll ban it. Now Trump is saying, no, maybe they're not going to ban it, and maybe he'll get somebody to buy it, so on and so forth. I'm not really sure, but I think it is good to hear that TikTok, or rather ByteDance, is still doing well, regardless of all this uncertainty. And, the fact that they are growing their business that well means that really the products are not too shabby.
Okay, and finally, before we let you go, Ben, let's talk about Walmart. Walmart posted mixed results yesterday, and its CEO also said that while he welcomed that dialing down of tensions between U.S. and China, U.S. tariffs remain too high for his firm to absorb. Any thoughts on that?
Not surprising, because Walmart's business, right, is basically like the Costco, the wholesale, the factory outlet type business. So I took a look at the numbers. Walmart's operating margin for 2024 was 4.3%. Profit margin was slightly under 3%. So it is very, very super thin margin. So any kind of extra cost, even now, the U.S. tariffs on China is 30%, way down than before, but any kind of extra cost is going to eat into that margin. So in order to survive, they have no choice but to increase sticker prices for shoppers. So that's a no-brainer. So obviously it's going to feed into inflation at some point. We're not seeing it in the April numbers. But if the tariff war continues, and even if we still have the 30% tariff, you're going to see some of that feed into the inflation numbers in the subsequent months.
I see. Thanks so much for the insights. As always, that was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.